So the age-old debate, do you go for a 2-year fix or do you go for a 5-year fixed? Now let's be honest, don't listen to your mate down the pub, don't listen to your parents from 25 years ago when they first bought their house. It's all down to you and circumstances. So in this video, I'm going to be talking about 2-year fixed rate mortgages and 5-year fixed rate mortgages to help you understand what's best for you. Hi, I'm Sam Fox and welcome to my YouTube channel. Here I talk about everything from finances, mortgages, money, whatever it might be. I'm trying to help as many people in the UK understand the home buying process. So if you like this content, please make sure you hit like and subscribe. So we've got a price war with lenders cutting rates due to market slowdown. We've got the Bank of England dropping base rates. 80% of brokers think that interest rates might rise, contrary to what everyone else is saying. And UK faces economic uncertainty, inflation, rising unemployment, and potential recession. It's all a lot. So here, we're going to explain to you the differences of a 2- and a 5-year fixed deal to help you on your... So let's look at the 5-year fixed rate. First and foremost, it's going to give you certainty and stability, and I love this product because it's absolutely great for budgeting. You know exactly what you're going to be spending your money on for the next 5 years, so it's great for planning. If interest rates go up around you, you'll remain unaffected. You can worry about that later on. Now, traditionally, a 2-year fixed rate of interest has always been cheaper, but over the last 5 years, since that little word called COVID's been here, 5 years have been cheaper than the 2 years, which shows you where the lenders are pricing in the market. So a 5-year is great for stability. Traditionally hasn't been cheaper than a 2-year, but it is proven to be a little bit cheaper at the moment. So it is great for you to consider. Now, some downsides to this are early repayment charges. So if you want to leave the property, for example, and sell it and not buy somewhere else, then you might have early repayment charges to pay up to 5% of the loan in year 1. They're typically a sliding scale, so in year 2 it's 4%, in year 3 it's 3%. Maths has just evaded me, but you get the gist, leading down to the last year, and you'll have a 1% fee in the last year. Other lenders are different, but that's just typically what you're looking at as well. So let's look at the 2-year deal. Now, 2 years are great because they do provide flexibility. So in that 2 years you own in the house, if the interest rates drop, and let's say you take a 4% rate and they continue to drop, you might be able to refinance on a 2.5% rate sooner than you would do on a 5-year. And a 2-year is also useful if your situation might change. For example, like I said there, you're going to move, or your income increases, or you're doing loads of work to the house and you want to remortgage to pull out that equity to do something else, buy somewhere else, buy a buy-to-let. It just gives you a little more options. The downside to the 2-year are that if interest rates rise in sort of 18 months, 24 months, then you could face a higher interest rate at renewal. And like we've seen short term, obviously the market's been a bit artificial with interest rates over the COVID period, but interest rates might go from 1% to a 6% overnight, and that can cause a lot of pressure, especially if you're taking on more debt after you've purchased the house as well. So look, which one do you choose? Do you go 2-year fixed or do you go 5-year fixed? Now, reflecting on what we've said there, let's look at your circumstances. If you're buying a house and there's no intentions of moving, and you're not buying a stopgap house and you want to stay there and you're comfortable and you're happy with the rates, go 5-year fixed. It's great for budgeting, and it means that you can rest easy. You know exactly what you're paying out. You can save, you can invest money, you can go on holidays, all that sort of stuff. Now, if your opinion is that you're buying somewhere and you're going to do a load of work to it, you're going to renovate it, you're going to add value, and you think, actually, I might get a better loan to value once I've done all this work, then a 2-year might be great for you, because you can review that within 18 months, potentially secure a low rate of interest, pull any money out you need to, or raise any extra money, or if you want to, you can move on to a bigger property as well. So it really depends on you. What I would say though is make sure you use a mortgage advisor to get that personalised guidance and help you understand if a 5-year fix is going to be better suited to you, or if you want the flexibility and if you're confident rates will fall, then a 2-year could save you money as well. But as I said, working with an advisor, they'll hold your hand throughout the whole process and make sure you're fully comfortable in the decision that you go with. So there's my take on 2-year fixed and 5-year fixed rate of interest. Now, if you're still undecided, all you need to do is drop a comment below and we'll respond to you to give you some guidance, or you can reach out to me direct. It's sam@ukmc.co.uk. Before you go, please like and subscribe. We'll link a load of videos at the end of this. Keep watching and we'll see you soon.